Picture this. It's Sunday night, markets are about to open, and every silver analyst on YouTube is screaming about $80. They're showing you charts, they're pumping hopium, they're telling you to prepare for the surge. But here's what none of them are explaining, and this is where things get really interesting. The $80 target isn't the story. It never was. What's happening right now in COMEX vaults? What's happening with Chinese export restrictions? What's happening with the paper-to-physical disconnect? That's the actual story. And if you understand what I'm about to walk you through, you'll see why institutions are positioning one way while retail is being told to position another way entirely. This isn't about price predictions. This is about understanding the mechanism behind why silver moves the way it does, and more importantly, who benefits when it moves. Let's start with what everyone's focused on, the $80 price target. It's a nice round number. It's above the all-time high. It gives people something to anchor their expectations to. But the question isn't whether silver hits $80. The question is what $80 actually represents in the context of a market that's been systematically managed for decades. Because while retail investors are celebrating price surges and checking their portfolios every 5 minutes, institutional players are looking at something completely different. They're looking at delivery obligations. They're looking at vault inventory. They're looking at the growing gap between what's traded on paper and what actually exists in physical form. See, when you trade silver futures on COMEX, you're trading a contract, a promise, a piece of paper that says you have the right to take delivery of physical silver at a specific price. Most of these contracts never go to delivery. They're settled in cash. The system works as long as most players are happy to take cash instead of metal. But something's changing. Over the past 18 months, delivery requests have been increasing. Not dramatically, not enough to make headlines, but enough that if you know where to look in the COMEX data, you can see the pressure building. Eligible inventory, the silver that's available for delivery, has been declining steadily. It's not gone. It's not even critically low yet. But the trajectory matters more than the absolute number, because markets don't break when they run out of something. They break when participants lose confidence that they can get what they're owed. And confidence is a psychological game. When paper silver trades at $29, while physical premiums are running $4 to $6 over spot, that tells you something about confidence. It tells you that people who want actual metal are willing to pay significantly more than the official price suggests it's worth. That's not normal. That's not how efficient markets are supposed to work. That's a symptom of a system under stress. Now here's where it gets interesting. China announced export restrictions on antimony and other critical materials back in late 2024. Antimony isn't silver, but it's part of the same strategic metals category. And the message those restrictions sent to global markets was clear. China is willing to use resource access as geopolitical leverage. Silver hasn't been explicitly restricted yet, but China is the world's largest silver producer after Mexico, and they're also the largest manufacturer of solar panels, which consume enormous amounts of silver. If China decides that domestic industrial demand takes priority over exports, or if they decide that holding physical silver is strategically valuable while the West plays paper games, the math changes overnight. So we've established that $80 isn't the real story. It's just the shiny object everyone's focused on, while the actual mechanism shifts underneath. Now, let's talk about what's actually happening inside the COMEX system, because this is where the documentary evidence lives. This is where you can see the pressure building in real numbers, not speculation. COMEX inventory data is public. Anyone can look it up. But most people don't know what they're looking at, and most YouTube silver channels aren't explaining it properly because honestly, it's boring, it's technical, and it doesn't generate the same excitement as predicting massive price surges. But if you're the kind of person who doesn't need your intelligence insulted, who wants to understand how the game actually works, this is the section that matters. COMEX silver inventory is divided into two categories, registered and eligible. Registered inventory is silver that's been allocated to specific futures contracts and is essentially spoken for, ready for delivery against those contracts. Eligible inventory is silver sitting in COMEX warehouses that could potentially be converted to registered if the owner decides to make it available for delivery. Total inventory is the sum of both. Now here's what's important. Over the past 2 years, we've seen total COMEX silver inventory decline from around 350 million ounces to under 300 million ounces. That's not a catastrophic drop. It's not empty. But the velocity matters. And more importantly, the registered portion, the silver actually available for immediate delivery, has been even more volatile. There have been months where registered inventory dropped below 50 million ounces. That sounds like a lot until you realize that global silver investment demand alone runs over 200 million ounces annually. The ratio between paper claims and physical inventory is where things get really interesting. On any given day, the total open interest in COMEX silver futures represents claims on somewhere between 600 million to 1 billion ounces of silver, depending on contract months and positions. But there's only 300 million ounces in the warehouses, and only a fraction of that is registered for delivery. Now, the standard defense of this system is that most contracts settle in cash, so you don't need one-to-one backing. And historically, that's been true. The futures market exists for price discovery and hedging, not physical delivery. But that defense only works as long as market participants believe they could take delivery if they wanted to. The moment that confidence breaks, the moment people start doubting whether COMEX can actually deliver physical metal against contracts, the whole pricing mechanism comes into question. We're starting to see signs of that confidence erosion. Physical premiums over spot have been persistently elevated. Delivery times for large wholesale orders have extended. And here's the kicker. Even though silver prices have been relatively range-bound between $22 and $32 for the past couple years, with brief spikes higher, the premium structure hasn't normalized. Normally, when prices rise, premiums compress because people are less willing to pay extra over spot. But we're seeing sustained premiums even during price strength. Alright, so we've covered why $80 is a distraction and we've walked through the COMEX inventory pressure. Now let's talk about what actually happens if the paper and physical markets decouple, because this is where most analysis falls apart. People love to predict dramatic crashes and defaults and system failures, but they don't walk through the actual mechanics of how a market breaks. And understanding those mechanics is what separates someone who's genuinely informed from someone who's just riding the hype cycle. So let's get into the specifics. Market decoupling doesn't mean paper silver goes to zero and physical silver goes to $1,000 overnight. That's not how it works. What happens is the spread between paper and physical widens to a point where the paper price stops being the reference point for physical transactions. We're already seeing early stages of this with the premium structure I mentioned earlier. When you can buy a silver futures contract at $29, but you have to pay $34 for a physical 1,000-ounce bar from a dealer, that's a $4 spread. In a normal, healthy market, that spread should be under $1, maybe $2 maximum to cover fabrication and dealer margins. A persistent $4 to $6 spread tells you the markets are already partially decoupled. They're still connected, people still reference the COMEX price, but physical buyers are essentially saying that price doesn't reflect physical reality. Now imagine that spread goes to $10, $15. At what point does a mining company look at the COMEX price and say, you know what, we're not hedging our production on COMEX anymore. We're going to sell directly to industrial users at physical prices. At what point does a sovereign wealth fund or a central bank say, we're not buying paper claims, we want allocated physical stored outside the COMEX system? This is already happening to some degree. We've seen central banks, particularly in Asia and Eastern Europe, increase physical gold and silver reserves significantly over the past 5 years. They're not doing that through futures contracts. They're taking delivery of physical metal. And every ounce that gets pulled out of the COMEX system and moved into sovereign vaults or private allocated storage is an ounce that's no longer available to backstop the paper market. Here's the part that doesn't get discussed enough: rehypothecation. In the banking system, the same collateral can be pledged multiple times across different transactions. There's reason to believe similar practices exist in the precious metals market, where the same physical inventory serves as backing for multiple paper claims. This isn't necessarily fraud, it's just how fractional systems work. But it means the actual ratio of paper claims to physical metal might be even higher than the official inventory numbers suggest. And if rehypothecation is widespread, and we don't really know the extent because it's not transparently reported, then any surge in delivery requests doesn't just drain inventory linearly, it drains it exponentially because each ounce of physical was backing multiple paper claims. So what does decoupling actually look like in practice? Probably something like this. COMEX silver trades at $45, but if you want to buy a 1,000-ounce bar for immediate delivery, you're paying $60. So we've walked through why the $80 target is a distraction. We've examined the COMEX inventory pressure, we've explored what decoupling looks like, and now we need to land this plane with something practical. Because analysis without application is just entertainment, and if you've made it this far, you're not here for entertainment. You're here to understand how to think about this market intelligently. So, let's talk about positioning versus predicting, and why that distinction matters more than any price target. Predicting is what most financial media does. They tell you silver is going to 80 or 100, or it's going to crash to 18. They give you a number, a timeline, maybe some chart patterns to justify it. And the problem with predictions is they're almost always wrong on timing, often wrong on magnitude. And even when they're directionally correct, they don't tell you what to do. Let's say silver does hit $80 in the next 12 months. Great. But did you hold through a 50% drawdown to get there? Did you panic sell at 60? Did you buy at 32 and feel like a genius at 80 only to watch it crash back to 45? Predictions don't help you navigate those questions. Positioning does. Positioning is about understanding the range of possible outcomes and structuring your exposure so you benefit from the outcomes you think are likely while protecting yourself from the outcomes you think are possible but less likely. In the silver market right now, here's what we know. Physical supply is tighter than paper pricing suggests. Industrial demand is growing particularly from solar and EV applications. Central banks and sovereign wealth funds are accumulating. COMEX inventory is under pressure, and geopolitical risks around supply chains are increasing. Those are facts, not predictions. The prediction part is whether those facts lead to higher prices, decoupling, system stress, or just a lot of volatility with no clear resolution. So how do you position for that? Well, first, you decide what you're actually trying to accomplish. Are you hedging against currency debasement? Then you probably want physical metal stored securely, regardless of short-term price movements. Are you speculating on a price move? Then you might use futures or options, accepting the leverage and the risk that comes with it. Are you building long-term wealth in hard assets? Then you're probably dollar-cost averaging into physical over time, not trying to time the market. The mistake most retail investors make is they mix these objectives. They buy physical silver but trade it like a momentum play. They check the price every day, they panic when it drops, they get euphoric when it spikes. That's not hard asset investing. That's just gambling with a different asset class. Here's what institutions do differently. They separate speculation from strategic holdings. If they want to speculate on silver prices, they use derivatives. They size the position appropriately. They have defined risk parameters. If they want strategic exposure to silver, they buy physical, they store it properly, and they don't look at the price for years.